Hi, this is Lisa Busto from Harper College. This is a brief review for Accounting 101 of Chapter 12, which covers the statement of cash flows. So first of all, we want to understand, although we covered this last in the text, there are 4 required financial statements. They are the income statement, the statement of retained earnings, and the balance sheet. The income statement, statement of retained earnings, balance sheet, and the statement of cash flows. So this is an important statement, but the reason that we wait till the end to cover this, the last chapter of the book, is because we need all that prior knowledge in order to be able to construct the statement of cash flows. So remember, we talked about the trial balance, and the trial balance is we talked about the trial balance early on in the class. That's not a required financial statement. We did some budgeting, we did some reconciliation work, but the only 4 required financial statements are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flow. So those are the 4 that are required. So this information, what we're doing is we're looking at the cash account and we're trying to see what happened to cash during the year. If our cash decreased, where did our cash go? If our cash increased, what happened to our cash? Where did we spend our cash? Remember that cash is king, and it's important for any business to run. So just like we need cash to pay our bills and put gas in our car and pay for different things, a company needs cash to run. So this statement of cash flow tells about the entity's ability to generate future cash, where they're spending their money, their ability to pay dividends and meet obligations, because remember, we can't pay dividends if we don't have retained earnings and enough cash on hand. Reasons for the difference between net income and net cash provided used by operating activities. And remember, our operating activities are generally our day-to-day activities. And then also we have our cash investing and financing transactions. We're going to talk about each of those as we go. So the statement of cash flows is organized into 3 sections. What's critical to understand is what bucket transactions fall into. Is it an operating activity, an investing activity, and financing activity? And we're trying to think, is it a cash inflow or a cash outflow? So this summary tells us the operating activities, and this is always the order that they're listed in. OIF, I always remembered. Operating, again, is our day-to-day transactions. They state that it is our income statement items. I think it's it's what we're in business to do. We buy inventory, we pay our employees, we pay taxes. Those things are our day-to-day activities. Investing activities can be summarized by the changes in investments and long-term assets. A lot of the investing activities are the purchase or sale of property, plant, and equipment. Financing activities, financing is how are we going to pay for something. If somebody says, how are you going to finance the car? You tell them, I'm going to go to a credit union, I'm going to get a loan, I have all cash, I don't need to finance it. This section tells us about companies, how are they going to get money to pay for things? Do they have to issue a bond? Do they have a loan? Are they going to issue stock and get cash from stockholders? Also important in this section is when we pay dividends to our stockholders. Again, transactions that impact our stockholders. If we receive dividends, that is in the operating section. So I think that's a little bit confusing. Although that's not really a day-to-day activity, that's where that's included. So the key to this chapter is understanding, okay, what is in operating activities. And you can see these are definitely, these outflows here, or from the sale of goods and services, normal business activities. We pay wages, we pay the government our taxes, lenders for interest. Then we have our investing activities. Again, it's a cash inflow from the sale of property, plant, and equipment, the sale of investments, the purchase of property, plant, and equipment, and the purchase of investments. Less common to make loans to other entities. And then our financing activity. How are we going to raise money to pay for things? Well, we could issue debt, bonds and notes. We could sell stock. Outflows in this category would be when we pay our stockholders dividends, or if we, remember we talked about in Chapter 11, treasury stock, when we buy back our own stock, so to redeem long-term debt or buy back our own stock. Okay. There are certain non-cash activities that are significant. Any non-cash activities are reported in a separate schedule at the bottom or a separate note to a financial statement. A significant non-cash activity, an example would be, I'm going to purchase a building in exchange for cash. So somebody's going to sell me, in exchange for stock. I'm going to buy the building, I'm trading an asset for my stock. I'm going to get the building. In exchange, I'm not going to pay them cash. I'm going to give them stock. Okay? Doesn't involve any cash, but it's a significant activity that investors would want to know about. So it didn't involve cash, but we still want to see that transaction somewhere, either in a separate schedule or in the notes of the financial statements. We talked about in this class, we are going to focus on the indirect method. We don't cover the direct method. So here's the layout of our statement of cash flows. Like our other financial statements, it has our company name, the title, and for a period. It's a period of time. Here's our sections: operating, investing, and financing. So we have 1, 2, 3. We're going to subtotal those 3 to get our net increase in cash. And the great thing about the statement of cash flows is we already have the answer. We can look at our comparative balance sheet, look at our cash at the beginning of the period and the end of the period, and that gives us our net increase in cash. So these 3 sections should add up to that change in cash. Okay, so let's go ahead and let's look at an example. So here is a comparative balance sheet. You will, I will post this in course materials so you can print it out and take a look at it and walk through it. It might even be helpful to stop the video at this point, see if you can create the statement of cash flows from this on your own, and then come back and see if you did it correctly. So remember, what we're trying to do here is we're trying to understand what happened to cash. At the end of 2011, our cash was $23,000, and at the end of 2012, it was $28,000. That's an increase of $5,000 cash. We know from our PowerPoint slide already that we're going to list that number right here. We know it already. We're going to pencil it in here on the side. We should come to, when we add these 3 numbers up, a positive $5,000 because it increased. So we know that, and we know our beginning cash and we know our ending cash. So what I do is I look at this and say, all right, let's look at, we know in the operating section we have our current assets and current liabilities that we have to account for. So these are all what I'm highlighting in blue. These are our current assets. These are our current liabilities. What else we need in that section is we need our net income, because we always start with net income. We also need depreciation expense. Since we have depreciation expense, notice it's $10,000. The change is $10,000. If we weren't provided for some reason this depreciation expense number, but they gave us accumulated depreciation, we would know it was $10,000. Okay, so I'm just going to cross this out because we already have this information. We don't need this. We already got this. Okay, so I'm going to make that black. Now I'm going to look and see, okay, what else do I have? So if I put next to here, this is operating, operating, operating. And I need depreciation for my operating and net income for operating. I like to mark things up so I don't even have to think about it, when I'm preparing it. The other section I have here next is land and building and furniture and fixtures. I know the sale of property and plant and equipment or the purchase goes in the investing section. So I'm going to put an I there. Then the last things I have are bonds payable and common stock. Again, those are ways to raise money, and that would go in the financing section. I got to find a different color here. Financing section. Retained earnings information we don't need because they provide us net income. We could recreate this and figure out net income if they give us the dividends. Oh, and here's another one we need. Dividends paid. This goes in the financing section. Now, a lot of times, they might give us extra information that we don't need. We don't need revenue, costs. We don't need any of this other stuff. Only the stuff that I've highlighted are things that we need. Okay? So then, here is the format of our statement of cash flows. I'm going to try and make this a little bit bigger. It'll be a little easier to see. All right, so we always start with our net income. And our net income from the previous page was $73,000. And if you have this, here's our net income, $73,000. We always add back our depreciation expense. So that's going to be the next thing that we need. If we had amortization expense, we'd add that back too. Then we had our current assets that we said was in the operating section, and we're going to calculate the change: current accounts receivable, inventory, and supplies. Now I had this chart posted in class if you were in my in-class session, and I would jot this little chart down because it's just easy. If my current assets increase, I'm going to subtract them. If my current assets decrease, I'm going to add them. If my current liabilities increase, I'm going to add it. If they decrease, I'm going to subtract. I always like to think that current liabilities are more cooperative. That's what I would always say. Because they increase, you add them. Decrease, you subtract them. Then you just remember the current assets are the opposite of that. So as I look at my accounts receivable, they go from $28,000 to $25,000. That is a decrease. So then I'm just going to write over here that I'm going to add that back. My inventory goes from $76,000 to $82,000. That's an increase. So I'm going to subtract. My supplies go from $28,000 to $21,000. That's a decrease, so I'm going to add. My liabilities, if they decrease, then I subtract. If they increase, I'm going to add. So now that I've done that for my current assets and current liabilities, $3,000 I said I'm going to add. So I go back to here, and you can go ahead and try it and see if you can do it before you look at the solution. So here are all my current assets and current liabilities. If I add these up, my subtotal is $91,000. Now the approach for investing and financing activities I think is very straightforward. If we look at this, we kind of just need to walk through it logically. In the beginning of the year I had $120,000 in land. Now I have $125,000. I now have more land. In order to get more land, that was a cash outflow. So I would subtract that. Furniture and fixture, I started the year with $300,000, but now in furniture and fixtures I have $418,000. Again, that's a cash outflow because now I have more furniture and fixtures. So the $5,000 and the $118,000 would both be subtractions. If I subtotal that, that would be negative $123,000. Now I go to my financing section. Again, I had three things there. Bonds. Okay, so you got to walk this through. Started with $100,000. Now this is a liability. My liability is increased $170,000. So I must have issued more bonds. That means that was a cash inflow. I received more cash. Common stock. I started the year with $100,000. Now I have $110,000 to get. When the stock went up, that means I issued more stock, and it's a cash inflow. Then dividends paid, that would be a cash outflow. Remember, the statement of cash flows is the sources and uses of cash. Now, remember, I go back to, I said we already had the answer when we knew we had to, our operating, investing, and financing had to come to the change in cash, which was $5,000. If I add these three numbers up, I get to my net increase in cash, which is $5,000. I add that to my beginning cash balance, $5,000 plus $23,000, which is my ending cash balance of $28,000. So hopefully that problem will help you understand the statement of cash flows. The key is understanding, and it might be important to review what transactions go where. So I think it's helpful to review and kind of pulling out what goes in each section. Thanks for watching. Happy studying.